The average American has $17,000 in their bank account right now. Except they don't. That number is real. It comes from the Federal Reserve's 2025 survey of consumer finances. 17,000 in liquid savings. Sounds reasonable, doesn't it? Maybe even reassuring. The problem is that averages are liars. They're statistical magic tricks that hide more than they reveal. Here's what actually happens when you calculate an average. You take a billionaire with $400 million in cash, you take 9,999 people with $800, you add them together, divide by 10,000, and suddenly everyone has $48,000. On paper, everyone looks fine. In reality, 9,999 people can't make rent. So let's stop pretending averages tell us anything useful about how actual humans live. Let's look at what the median American actually has, actually earns, actually owes, and actually faces in 2026. Because the gap between the statistical American and the real one is where the entire story lives. Before we break down these numbers, quick thing. If you want more videos that cut through the financial noise and show you what's actually happening with money in America, subscribe. We do this every week. No hype, no fluff, just the numbers that matter and what they actually mean for real people. How much does the average American make? According to the Bureau of Labor Statistics, the median household income in the United States is now $68,000. Not average. Median. That means half of all households make more, half make less. It's the middle. The actual middle. 68,000 sounds survivable. It sounds like a life. But let's immediately complicate that number because that number is a household, not a person. A household can be one person, can be two, can be five. The composition matters. For an individual worker, the median personal income is $41,000. That's what half of all workers make or less. $41,000 before taxes. After federal income tax, Social Security, Medicare, and state taxes where applicable, that 41 becomes somewhere around $32,000 in take-home pay. That's $2,600 a month. Now let's add another layer. That 68,000 household number assumes someone is working full-time. But according to the Census Bureau, about 27% of American workers are part-time, gig-based, or seasonally employed. Their income is irregular. Their hours fluctuate. They exist in a space where monthly income and even for full-time workers, income hasn't moved the way people think it has. Adjusted for inflation, real median household income is only 11% higher than it was in 1999. 11% over 27 years. That's 0.4% annual growth. Meanwhile, housing costs have risen 83%. Healthcare is up 117%. College tuition is up 180%. So when someone says the median household makes $68,000, what they're actually describing is a number that buys significantly less than it did a generation ago, earned by people working more hours in less stable conditions with fewer benefits. Income is the starting point, but it's not the story. The story is what happens after the income arrives. Let's go back to that $17,000 savings figure. The one that's technically true and functionally meaningless. The Federal Reserve breaks this down further. The median American household has $5,300 in savings. Not $17,000. $5,300. That's the middle. Half have more. Half have less. But even that number hides an uglier truth. 37% of Americans couldn't cover a $400 emergency expense without borrowing or selling something. For $100. That's not a medical emergency. That's not a car transmission. That's a broken refrigerator. A chipped tooth. A last-minute flight. For those households, savings isn't a cushion. It's a rounding error. And here's where it gets strange. When you ask Americans how much they think they need in an emergency fund, the most common answer is somewhere between 3 to 6 months of expenses. Financial advisors agree. 3 to 6 months. That's the standard. For a household making $68,000, 6 months of expenses is roughly $34,000. The median household has $5,300. They're 16% of the way there. And that's the median. Half are below that. The psychological gap between what people are told they need and what they actually have creates a constant low-level hum of financial anxiety. It's not panic. It's not crisis. It's just the awareness that one bad month could destabilize everything. Now let's look at who actually has savings. Households in the top 10% by income have a median of $250,000 in liquid assets. The bottom 50% has a median of $800. Not 800,000. 800. This is what inequality looks like in savings form. It's not that the bottom half is reckless or careless. It's that when you're earning $30,000 a year, savings isn't a decision. It's a luxury that doesn't fit into the monthly math. And the monthly math is where everything breaks down. Savings is what you have. Debt is what you owe. And in America, the second number is almost always bigger than the first. The average American household carries $104,000 in debt. But again, average is the wrong lens. The median is closer to $67,000. That's credit cards, car loans, student loans, medical debt, and mortgages combined. Let's break it apart. Credit card debt. The average cardholder owes $7,000. The median is closer to $3,000. Interest rates on credit cards are now averaging 22%. That means if you carry a $3,000 balance and make minimum payments, you'll pay it off in about 14 years and spend roughly $4,000 in interest. You'll pay $7,000 total to borrow $3,000. Student loans. 43 million Americans have student debt. The average borrower owes $38,000. But that average is skewed by people with advanced degrees who owe 6 figures. The median undergraduate borrower owes around $28,000. Monthly payments typically range from $200 to $400. For someone making $41,000 a year, that's 10% of their gross income going to a degree they finished years ago. Auto loans. The average car loan is now $39,000. Monthly payments average $736. The average loan term is 68 months. That's nearly 6 years of payments on a depreciating asset that loses 15% of its value the moment you drive it off the lot. Medical debt. 53 million Americans have medical debt. The median amount owed is $2,000. But here's the absurdity. 46% of people with medical debt say they were insured when they incurred it. They had insurance and still ended up in collections. Mortgages we'll come back to because mortgages are their own special trap. Add it all up and here's what you get. The median American household brings in $68,000, has $5,000 in savings, and owes $67,000. The debt is 13 times larger than the savings. And every month, a significant portion of that income goes not to building wealth or security, but to servicing the debt they've already accumulated. This is the treadmill. You work to pay what you owe. What you owe grows faster than what you earn. The gap widens. And savings, if it happens at all, happens in the cracks. Housing is where the American financial story goes from uncomfortable to absurd. The median home price in the United States is now $397,000. In 2020, it was $329,000. In 2015, it was $296,000. In 2000, it was $165,000. Home prices have more than doubled in 26 years. Median household income has grown 11%. Let's do the math everyone pretends doesn't exist. To afford a $397,000 home, you typically need a down payment of 20% to avoid private mortgage insurance. That's $79,000. The median household has $5,300 in savings. So most buyers don't put down 20%. They put down 3%, sometimes 0 if they qualify for certain programs. Let's say they put down 3%. That's $12,000. They finance $385,000 at a 7% interest rate, which is roughly where rates sit in early 2026. The monthly mortgage payment is $2,560. Add property taxes, homeowners insurance, and maintenance, and you're looking at $3,000 to $3,200 a month. For a household making $68,000 a year, that's about $5,600 a month before taxes. After taxes, closer to $4,300. $3,000 of $4,300 is 70% of take-home pay. The recommended maximum is 30%. And here's the cruelest part. Over the life of that 30-year mortgage, they'll pay $921,000 total. For a house worth $397,000. They'll pay more than twice the value of the home in interest, but they don't have a choice because the alternative is renting. And rent isn't cheaper. The median rent in the U.S. is now $2,200 a month. Renters spend, on average, 32% of their income on rent. But in major cities, it's closer to 40 or 50%. And rent doesn't build equity. It doesn't appreciate. It's just gone. So Americans face a choice. Pay 70% of your income to own something that might appreciate, or pay 40% to own nothing. Either way, housing is the largest expense, the least flexible cost, and the thing that makes every other financial goal nearly impossible to reach. And if you think this is sustainable, look at homeownership rates. In 2004, 69% of Americans owned homes. In 2026, it's 65%. Ownership is declining. The people being priced out aren't recovering. They're just renting longer, saving less, and aging into retirement without the asset that previous generations used to fund their later years. Retirement in America used to be simple. You worked for a company for 30 years. They gave you a pension. You retired at 65. You lived modestly and died before the money ran out. That system is gone. Only 15% of private sector workers have access to a pension. Everyone else has a 401k, which is not a guarantee. It's a gamble wrapped in tax advantages. Here's how much the median American has saved for retirement by age. Ages 18 to 34, $7,000. Ages 35 to 44, $35,000. Ages 45 to 54, $78,000. Ages 55 to 64, $120,000. Financial advisors suggest you need roughly 10 times your annual income saved by retirement to maintain your lifestyle. For someone making $68,000, the median near retiree has $120,000. They're 18% of the way there, and that assumes the market doesn't crash. It assumes they don't need to pull money out early for an emergency. It assumes their health holds and they don't face long-term care costs that run $3,500 a month per person. Social Security helps, but only partially. The average Social Security benefit is $1,900 a month. If your housing costs $3,000, Social Security doesn't cover your mortgage, let alone food, utilities, healthcare, or transportation. So what actually happens? People work longer. Retirement age keeps creeping upward. 65 becomes 67 becomes 70. And even then, many retirees live on significantly less than they did while working, because the math doesn't support anything else. The irony is that Americans are told to save for retirement from their 20s onward. But when you're making $41,000, paying $3,000 in rent or mortgage, servicing debt, and trying to keep food on the table, retirement savings is a theoretical concept. Something you'll get to later. Except later never comes because the expenses don't shrink. They grow. And unlike previous generations who could rely on home equity, today's near retirees either don't own homes or are still paying them off. The safety net their parents had doesn't exist for them. Retirement isn't a plan anymore. It's a hope. Let's zoom out and look at where money actually goes each month for the median household. Total monthly take-home income after taxes, roughly $4,300. Housing, mortgage or rent, insurance, utilities, $3,000. Remaining, $1,300. Transportation, car payment, insurance, gas, maintenance, $700. Remaining, $600. Groceries, $500. Remaining, $100. We haven't touched healthcare premiums, phone bills, internet, clothing, childcare, or debt payments beyond the car. And we're already at $100 left. The median household with children spends about $1,200 a month on childcare. That alone blows the budget into the negative. This is why savings doesn't happen. This is why 40% of Americans would struggle with a $400 emergency. There's no margin. There's no slack. The monthly expenses consume the monthly income, and anything left over is a rounding error. And this assumes stability. It assumes no one gets sick. No one loses a job. The car doesn't break down. The roof doesn't leak. The kids don't need braces. The moment any of those things happen, the budget doesn't bend. It breaks. And that's when people turn to credit cards, personal loans, or family. They patch the gap with debt, which adds another monthly payment, which tightens the budget further. It's a cycle. And the tighter it gets, the harder it is to. Now let's talk about where you actually fit. If your household makes $68,000, you're exactly median. You're in the 50th percentile. Half of America makes more. Half makes less. If your household makes $100,000, you're in the 67th percentile. You're doing better than 2/3 of the country. If your household makes $200,000, you're in the 90th percentile. You're in the top 10%. Here's what's strange. People in the top 10% often don't feel wealthy. They feel middle class. They still have mortgages. They still have student loans. They still worry about retirement. And they're not wrong to worry, because even at $200,000, living in a high-cost city with kids and debt can leave very little margin. The gap between feeling secure and actually being secure is wider than people think. Now flip it. If your household makes $40,000, you're in the 35th percentile. 1/3 of the country makes less than you. 2/3 make more. At $40,000, you're below the median, but you're not an outlier. Millions of households are right there with you. If your household makes $25,000, you're in the 20th percentile. 80% of households make more. Here's what the percentiles reveal. The middle is more fragile than it appears. Being median doesn't mean comfortable. It means you're holding on, same as everyone else. And the distance between the 20th percentile and the 90th is so vast that comparing yourself to either extreme is functionally meaningless. The person making $40,000 and the person making $200,000 are both called middle class in American discourse, even though their financial realities have almost nothing in common. So when people ask how they stack up, the better question is, stack up to what? To the statistical median? To their parents' generation? To their own expectations? Because the most damaging comparison isn't with other people. It's with the version of American life that people were told to expect. The version where a college degree meant stability. Where hard work meant homeownership. Where saving meant security. That version still exists in the cultural narrative. It just doesn't exist in the actual economy. Let's pull back one more layer. Everything we've discussed, income, savings, debt, housing, retirement, is described in individual terms. Your salary, your savings, your debt. But these aren't individual problems. They're structural ones. Wages have stagnated while productivity has soared. Workers produce more value than ever, but they capture less of it. The gap goes to shareholders, executives, and asset owners. Housing prices have exploded not because there's a shortage of land, but because housing has been financialized. It's treated as an investment vehicle, not a human necessity. When homes are assets first and shelter second, prices rise until people can't afford them. That's not a bug. That's the design. Healthcare costs are out of control not because care is expensive to provide, but because the system is optimized for profit extraction at every level. Insurance companies, hospital networks, pharmaceutical companies, all of them extract maximum value from people who have no choice but to pay. Student debt exists at this scale because states defunded public universities and shifted the cost to individuals. Tuition rose, loans grew, and an entire generation entered adulthood financially hobbled before they earned their first real paycheck. Minimal flat vector illustration of the main cartoon character with rounded head, short dark hair, orange long-sleeve shirt, blue pants, and orange shoes standing beneath large abstract policy blocks labeled only by symbols for markets and rules. Visual metaphor for outcomes driven by policy, not personal failure. Clean, bold outlines, pure white background. Flat vector scene showing the main cartoon character working at a desk producing value blocks, while those blocks move upward into a funnel labeled by abstract shareholder and market icons. Visual metaphor for prioritizing efficiency and shareholder value, minimalist style, white background. Minimal cartoon illustration of the main character standing beside a faded silhouette of parents holding a house and stability symbols, while the character holds a paycheck but no house. Visual metaphor for earning more nominally but affording less. Clean, bold outlines, white background. Flat vector scene of the main character surrounded by rising charts for GDP, stock market, and corporate profits, all floating upward above their head, while the character remains on a flat ground line. Visual metaphor for growth that doesn't lift everyone, minimalist composition, white background. Minimal cartoon illustration of a tall coin tower at the top with a small group of abstract figures standing comfortably, while a large group including the main character stands below on a thin strip of coins. Visual metaphor for wealth concentration, clean, bold outlines, pure white background. Flat vector scene showing the main cartoon character running on a treadmill made of arrows pointing forward, working harder while staying in the same place. Visual metaphor for treading water, minimalist style, white background. Minimal flat vector closing illustration of the main cartoon character looking up at a wide system-shaped structure where most wealth flows upward. Visual metaphor for gains pooling at the top, clean, bold outlines, soft muted co. So here's where we are in 2026. The median American household makes $68,000. They have $5,000 in savings and $67,000 in debt. They spend half to 70% of their income on housing. They're woefully unprepared for retirement, and they're one bad month away from financial instability. These numbers aren't outliers. They're not worst-case scenarios. They're the middle, the normal, the default American experience. And the question nobody wants to ask out loud is this: if this is what median looks like, if this is the result of doing everything right, working full-time, staying employed, avoiding major disasters, then what exactly is the system producing? Not security, not mobility, not the broadly shared prosperity that the American story promises. Just a treadmill that spins faster every year. And the quiet, creeping suspicion that no matter how hard you run, you're not actually getting anywhere. If this breakdown helped you understand where you actually stand in the American economy, hit the like button. And if you want more videos breaking down the financial systems that shape your life, subscribe. We're cutting through the noise every week.